inflation, all other things being equal, it's probably good for housing.
Yeah, hi, Tyler. Thanks for having me on. So, yeah, real estate's always been somewhat of an inflation-protected asset and does indeed put upward pressure on inflation ultimately. But in real terms, that does lead to, higher wealth because it is sort of a store of value. And so it cuts both ways.
So, and of course, the higher wealth, the wealth effect of rising house prices makes people feel more affluent, so they're more inclined to spend. It's a sign of a good economy. Let's talk about where in housing you find the greatest opportunities now. Obviously, there are the home builders, then there are the companies that benefit from home repair and improvement, whether it's a Home Depot, a Lowe's, or furnishings retailers. Where do you find the sweet spot, or is it across the board?
It's really across the board, Tyler. I mean, there's the home builders, and there's a lot of names on there. There's the home improvement names, which continues to be very strong, and then it's the knock-on effects. There is $200 billion annualized in home equity withdrawals occurring now. That's 1% of GDP, and that's fueling spending in a lot of other high-end areas, such as RVs, boats, high-end retailers. And even things like self-storage, where you have to, temporarily store your stuff as housing activity continues. And so we'd be focusing on all of those areas. I think they'll continue to be strong. Housing inventories remain extremely low. And to us, that is the key barometer of future housing activity in the markets across the U.S.
If there is an Achilles heel that could bring this virtuous cycle to a close, is it rising interest rates? And how high would they have to rise before home buyers would pull back and home values would arrest?
Yeah, so first of all, mortgage rates have not risen as much as treasury rates, longer-term treasury rates. So there's been less of an impact on higher rates recently to mortgages. Secondly, I think if the 10-year yield got above 2%, you start to see a slowdown effect in housing with a lag, naturally, as the overall affordability lessens, and clearly for that. Our forecast is interest rates are going to remain range-bound on the long end, and that continues to support housing activity while the yield curve continues to flatten, in the short end.
That's a different picture, perhaps, than our last guest was just painting, who sees rates going up pretty much across the curve. Why don't you think they're going to go higher on the long end? And do you just mean 30 or even on 10 years?
Yeah, we continue to believe. So we think anything beyond 10 years and beyond will continue to be range bound. And we think the Fed is going to be behind the curve still. If anything, Brainerd being added as vice chair and several other additional appointments forthcoming leans incrementally dovish next year rather than this year. And that's going to put upward pressure on short-term rates because the market's going to take the view that inflation isn't under control. And ultimately, market taking the view the Fed's going to have to ultimately act at some point, and that keeps those long rates relatively low and range-bound.
All righty, Chris, thank you very much. Chris Senyek, we appreciate your time today.
Thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.